Peter, are you with us here today?
I am, Eddie. How are you?
Peter, very nice to have you here, and I'd like to thank you for staying up to the wee hours in the morning. What time you got over there today?
It's 1 a.m. I've actually been to bed and woke up again.
Okay, well, we'll keep this short. What, 5 minutes?
That
We'll
should do
let you,
it.
let you get back to sleep. All right. Well, Peter, very nice to have you here. A good friend and a expert educator here at Top Step Trader for a very long time. And Peter, talking about the anatomy of a churn. Now, um, can you give us a little insight on this? I know that I've been talking about the fake of the reversal, the market reversal. That's where we get the anatomy of a turn, being caught with these fake reversals, how to distinguish them between the fakes and the actuals. But I'll give you the microphone and we can start. Oh, real quick before we do, for our guests here, I'm going to post it one more time. If you'd like to join us here for Peter's presentation, he has a visual for us. Please click on the link, and that'll get you into the room.
Okay, shall I take the floor, Eddie?
You got it, my friend.
Okay. Right, so we're going to talk about the anatomy of a turn today. Before I get into the details, I'd like to take a few minutes to consider the philosophy on which this type of analysis is based. That's not because I'm going to go through some oddball set of theories here, but because for me, there has to be a valid reason for taking a trade. So for me, the reason can't be buy when this line crosses that line. That's not a reason. It's a call to action. It's a rule for sure, but it's not a reason. So that may well be a valid time to buy, but for me personally, I need to know why in order to be able to pull the trigger. So when I buy, I do so because I believe other people will buy after me and move price up. So to trade, I need the confidence to truly believe that others will actually do that. So in order to place a trade with confidence, I need to be working within a common sense framework, something rational I can actually believe in. And armed with the why, you can actually develop your own techniques and ways to act on the information. So if we only discuss how, it's going to be hard for you guys to kind of extend and adapt these ideas. Now, when I first started trading, this is how I saw myself in the market. So there's me on the left. I obviously saw myself as a human. On the right is the markets. Now, I saw the markets as a thing. I didn't really understand what that thing was. I came to understand it had many moving parts and many related markets. So I spent time looking at index futures, then looking at the stocks, wondering which one was the tail and which one was the dog, which one was going to lead the other. I then looked at inverse correlated markets, I looked at the stock options, I looked at futures options, looking at currency, and before long I had this massive relationships that I was convinced I had to make some kind of sense of. And I also saw the market as a non-human entity. I had some vision that it was some kind of robotic or mechanical entity. Partly because of all the HFT hype and partly probably because I'm a bit of a geek at heart. So now I've kind of gone all vegetarian or all organic, and I really do see the market as something much more organic now. So this is how I look at the market, and I believe this is the best way to look at it. So the market is not them. The market is not something. The market is actually me. The market consists of many fairly normal people just like me trying their best to squeeze a few dollars out. Now, of course, the markets have their fair share of crazies too. So I know a guy that is most likely bipolar, not diagnosed, but he shouts and screams a lot and he trades an account of over $30 million. Now, if one of his analysts misses an opportunity, he'll shout and scream at them for 2 hours, completely oblivious to the fact that his rants missed another 20 opportunities. Now, this guy is also very profitable. So let's confuse this normal people thing with the misconception that there's a single personality type that makes a profitable trader. Okay? Now, I don't see these other people in the market as having more intelligence than me. I don't see them as having secrets that I don't have. Absolutely, some of them have more guts than me. Some of them have more risk appetite and much larger accounts than me. but I try not to consider myself as inferior. I see them as my peers. Now, I do see these people, of course, as all having their own ideas about what makes the market move. Some of them are actually quite predictable, and some of them not so much. But in essence, I see the market as a mass of people all trying to take action based on the actions they believe everybody else is going to take next. Now, obviously, that's going to give you a bit of a headache if you think about it too much. Now, I'm a day trader. I trade outright positions. I buy with the hope I can sell higher. I sell with the hope I can buy lower. Now, not everybody is doing that. So first thing I need to do is I need to figure out a way to deal with the fact that some of the people trading are not even playing the same game as me. So, for example, stat arb traders and spreaders don't trade directionally. They take two or more simultaneous positions and they trade the relationship between the two. So they don't care what happens in one instrument unless that relationship breaks down. So there's going to be some positions taken that are in most cases market neutral. So these guys are not going to get stopped out because price moves against them in one of the specific markets they're trading. You also have longer term traders. Okay, so I'm a day trader. These longer term traders will of course get into positions intraday, just like the stat arbs and spreaders, but they're unlikely to care where the market goes afterwards on that day. Now, of course, if the market crashes, they could unwind that day, but generally speaking, it's another case where they're going to establish positions intraday, and they couldn't really care what happens in that market after that. Now, there are, of course, lots of other reasons to take trades, such as hedging, but instead of going through every possible sort of trade, let's just agree that some trades are market neutral intraday and see what we have left. So the guys that we have left is short-term traders, day traders of all shapes and sizes. Now, it is difficult to know with absolute certainty what percentage of trading is short-term speculation. Now, in the markets I trade, my observations lead me to believe that the vast majority of trading is short-term speculation. And when I say vast majority, I would say 80 to 90% or more of the trading in index futures would be short-term speculation in my estimate. Okay, it's going to be different in other markets, but for index futures, treasuries, oil, it appears that most of the trading is short-term speculation. And that is where we loop back to the philosophy or the theory on which this discussion is based. The fact is, it's short-term traders that react short-term and give you short-term opportunities. And it's those traders and their positions that you care about. Now, there's this phrase that you hear a lot about called the smart money. Now, I remember a number of years ago taking a trading course that I paid the sum of $6,000 for. Now, I paid my money along with 10 other people. I got the course materials and then proceeded to watch the educator trade live. And over the course of about 2 or 3 months, we watched as he lost the $60,000 we'd paid him chasing what he called wholesale prices. Now, his idea was that the smart money bought at the lows and sold at the highs. And he was always trying to buy moves down and sell moves up. And even when he made totally stupid trades, and he'd hold them when they went against him 10 points, he'd say afterwards, well, even though I lost, it was a good trade. I bought wholesale. Now, of course, if you look at how much volume buys at the lows sometimes, it's often just a handful of contracts. So maybe 100 contracts. So we'd have to believe that 100 contracts is the smart money, and that turned the market around, and that everyone else that bought on the way up is a rank amateur because they didn't buy wholesale. Oh, and by the way, this trader is still selling his trading material. Okay? So today, we're going to discuss the anatomy of a turn, and that is major reversals, lower the day and higher the day stuff. This is smart money trading, but this is not necessarily buying at the low or selling at the high every day. Okay? That's possible sometimes, but mostly it's possible when the market moves back to the low with weakness and gives you another chance to get in. Okay? Now, in fact, what we're going to talk about today, we should perhaps separate this anatomy of a turn from where do I enter. So if you're looking to buy the low of the day at a predetermined price point, you can still do that. Okay, this doesn't change. But when you understand the anatomy of a turn, it's going to help you understand earlier whether your trade is working or not. Or you can wait for confirmation before trading against the old trade. So consider this a set of information. You can use it to refine your entry points. You can use it to set your bias. You can use it to confirm entries you've already taken. Or you can use it to completely change the way you trade. It's up to you. But for those of you that are consistently fading the market and getting run over, this will absolutely help you stop fading every move just because the market's taking a breather. And we'll see that it is your fading behavior, if you're one of these guys, that's actually helping to power the continuation of moves. Okay, so what we're going to do is we're going to look at a day, and we're going to look at a day from earlier this week. So this is the 3rd of February. And what we have here, we have an opening price. This was the open, 96.75. Now, straight off the open, we can't look for a reversal because to have a reversal, you need some direction. Okay, so whilst there are trades you can take off the open, it's best to let that initial flurry of activity play out and for the market to establish itself directionally. And that's going to make sense later on. Now, some days that means sitting aside for the first 15 minutes. And sometimes on really erratic days, it doesn't calm down till 10:15, 10:30. And sometimes, obviously, we just get range bound all day. Now, what you can look out for early on is the return to the open. So that's generally a pivotal price, a price where there's a battle. If it keeps crossing over the open with no real reaction there, then you generally end up looking at a directionless market. You often get a bit of a battle around the open price before it cleanly pulls away. And on a clean pull away from the open, that's when we have some direction. Okay, and that's when we can presume that everybody else that's watching the market that you're watching can actually see that direction, and that other traders will jump on it, because that's what you need. We're talking about other traders trading in their positions. Okay, so we need traders to join a move. So anyone that gets short, okay, needs to buy to unwind that position, and anyone that gets long needs to sell to unwind that position. So in this case today, we're going to watch this market move down initially, and as it moves down, it's going to gather future buyers. Okay, it's the sellers on the way down have to buy to exit. Okay, so we've moved down from the open, and we've formed over here, this is the volume profile over here, and we've got two areas with higher than average volume. Okay, and what that means is there are more positions in those two areas. Okay, now I mean long and short positions. Okay, so the X's over here, they just represent an area where a lot of volume was traded overnight, and that makes it an area that we're going to kind of be wary of and look out for, because obviously there are positions there too. Okay, excuse me, my cursor keeps disappearing. Now, whilst we're looking at the positions from the day session here, it always pays to consider the areas where there's a lot of positions from overnight. Now, some of the other things we can see on this screen, we can see the Dow up here, which is totally neutral, and we can see the NYSE ticker over here, which kind of started off bullish, but it's now declined to neutral. So right now, we haven't really established direction, even though we've moved down 7 points. Okay, the ES is very volatile right now, as you all know. If you're trading the ES right now, it's really volatile, and in more liquid times when it's less volatile, we might actually be quite concerned about a market moving 7 points without it really showing its hand. But in this case, it's volatile. We know there's plenty of room for this market to run. Now from here, we could do a couple of things. We could actually start to fill out this area in the middle, trade more volume in this area in the middle. So that would be kind of widening this range from 92 down here to 97.25. But our preference, obviously, if we want to trade directionally, our preference would be for the market to break down so that we see the longs in this area get stopped out. And that would give us a stronger directional bias. Longs that just lost money are longs that won't jump in again in a hurry. Now, what we can also see at this time over here is that the delta is rising. This is the cumulative delta. which is simply net buys, buy market orders minus sell market orders. Okay, for various reasons we look at that. We're not going to cover that today. But we actually have more buy market orders than sell market orders. And we also have these power meters over here. And again, this is showing all trades. This one down here is showing just the large trades. We do actually have more buy market orders than sell market orders at this point. So we're in a range, and it's not that ranges are bad. Okay, so we can trade ranges, but today we're going to discuss reversals of intraday trends and not fading established ranges. Okay, so we want the longs to get stopped out because of what that means for continuation and eventual reversal. Okay, so now we have our breakdown. So the market is now officially in an intraday downtrend. So for me, bias now is short until a confirmed reversal is in. Now, if we consider the positions that we built above, many of the longs are now washed out. Okay, we've moved down. The guys that got long in this area are washed out. The shorts are pretty happy. Now, on this volume profile, what we can see, very simple, the total number of contracts at each level. And if we look in the white box, we can see that as we move down, a smaller amount of contracts traded at each level. Now that's indicative of a more rapid move, or just stops getting triggered. Now we can also, if we look over here on the far right, this is shown as the total trades that hit the bid and total trades that hit the offer. So the red here is the total trades that hit the bid, which means they're sell market orders, and the blue is total trades that hit the offer, which is buy market orders. And we can see more volume hitting the bid side, more sell market orders hitting the bid side as it moved down. Now, this is partly an indication of how much time we've spent at each level. So if the sellers are taking out the bids rapidly, the whole bid is going to be taken out fairly quickly. And whilst those buyers are active pushing the market down, there's not actually much time spent at those levels. Okay, so we don't actually see a lot of trading on the opposite side. So again, it just kind of tells us a bit more about the pace of the market. Then when we get to this lower red box, we can see very early signs of another range forming. Now, this is partly, so we can see the range forming, and we can see more positions building. So now we've got our eye on this area here. If we look at the Dow, we can also see the Dow's moving down. If we look at the Nasdaq, well, that chart stuck for some reason on yesterday afternoon. I have no idea what happened there, but we kind of have to live with that because this is a slideshow from a recording of February the 3rd. We can see the ticks slightly negative. We can see the deltas starting to move down, but we are at yesterday's low, so we should be a little bit cautious. Now, at this point, as we said, many of the longs in this area here are washed out. We can tell that because we can see the drops have been triggered, and we can expect absolutely that when we get back up there, there's going to be an imbalance. Okay, we expect the buyers to stand off unless they have a good cause to think the market's already reversed. This lower range is still young, so we actually want some more positions to build here. We want people to fade this move and go long, because those are the people that will help us move down when they get stopped out. Now, we want the market also to stay here for a while. We don't want the market to just keep moving down, because the longer it stays in this area, the more people will say, oh, that's a bottom, and the more people are going to join and go long. Now, just for reference, as I said, these 2 meters very important as we go through this. This one here, the blue here, is just showing buy market orders above 100 contracts. This is sell market orders above 100 contracts, and on the right here, this is all buy market orders, all sell market orders. We'll have more on that later, but just keep an eye on it. Okay, so a few minutes later, we can see that the range has sort of filled out. Now we've got a lot more positions here. In fact, we've got a lot more positions here in this range than we had in the range above. And what I've done is I've actually cleared these meters so we can actually have a look and consider how many trades are building now that we've had another push down. Now, we did actually trade up and tag this volume area up here, but that held. Now that gives us a little bit of extra confidence to short the market from above, and that is a good pullback entry. Now, whether you hit that pullback when it comes up here, or whether you see it hold and come back to this range, there's lots of room to take these trades. Okay, and as I say, we're not really talking about entry here. We're kind of talking about the market behavior. Now, if we look at some of the other the things that are going on, the Dow looks fairly neutral. You know, it's coming up off its highs. Delta is dropping, but really not any significant amount. The NYSE tick is neutral. Yeah, the meters are slightly negative. And if we just look over here, this 14K, that 14,000 contracts, it's so far, we're moving up, but it's a fairly weak move. So we're in a temporary range. We can't expect it to appear really bearish. So when we start to build these ranges, we can't look for signs that it's really bearish, because people are participating and actually going long. But there's nothing really here that says this market has turned around and we should go wrong. Okay, so if we break down and start breaking through these prices here, the guys that went long in this area are going to bail out, and that's going to help to push the market down. Okay, and because we've got this push up here, there's going to be a lot more people do that, because people are seeing this push up, they're going long, they're getting all excited, and those are the guys that help us to push down some more, as we can see. So this big move down here is basically the result of us, this time round, we actually spent more time in that area, and we built more volume. Okay, so when the stops were triggered, there were a lot more of them, and those short-term directional long traders bailed out of their reversal trades. Now, we can see again how one-sided the trading is on the way down, but this time, with so many more thousands of positions built above, we have a lot more longs getting stopped out. Now, it also helps that we've actually gone through the low of the Globex session, so we're also washing out some of the stops from overnight too. Now, we can see an area down here where we have a little bit of two-sided action. So that's the next area where we expect to build volume. So our expectation is that we should trade here for a while, and we want people to go long in this area. Okay. Now the tape tells us that so far we had large sellers selling down to 78.50, and they're still pretty active as we move back up. Okay, so we do have a mix of some large sellers, and we have a few large buyers in the mix as well. So don't think that the only people getting trapped are retail traders. There's plenty of large traders throwing size at the market. They're going to get trapped. Now, in the previous slide, if we look at the power meters, the previous slide, the power meter over here, all trades, was about minus 4,000. The one down here was about minus 1.8, and we're now minus 10k and minus 7k. So again, that kind of just gives an indication of the imbalance on the sell on the buy side, or sorry, on the sell side as we move down. Now the NYSE tick went down, but again, not a huge move. It's the average tick only down to 400. And the delta itself, the delta's moved down quite a lot. So we have downward momentum. We have a market that's stalled temporarily. And right now, traders are looking at this big push down. They're seeing it stall, and they think it's bottomed out, and they're going to start buying it. Okay, so just because it's actually come back up, started to move back up, people are going to go long again. Okay, so people are just buying based on the fact that the market's stalled. Okay, but this is how markets move. They move, they build volume, they move, they build volume, and so on and so on. Okay, now of course, part of this building volume is traders in short positions taking profits. Part of it, you know, these trades here, it's going to be statistical arbitrage. Some of it will be long-term positions, but what makes the market move up or down from here is the short-term traders in this range getting stopped out. Now, nobody knows which side is going to get stopped out, but the probability is on the side of a continuation down. Okay, so we've got another breakdown, another range, another area where we have the one-sided trading, and that changes to two-sided trading. Now, we didn't get as much volume this time, so we don't have as much of a push down. Okay, and down we go again. And this time we've pushed down. We don't have the range yet, okay, but we have potential. And actually at this point, I'm expecting someone in the audience to say, wait. This guy's actually supposed to be showing us the anatomy of a reversal. And there hasn't been a reversal yet. And of course, well, one way we look at it, we could actually say there have been 1, 2, 3, 4 reversals because we've got 4 pullbacks, and they are certainly types of reversal. But part of what a reversal looks like and knowing how to recognize a reversal is actually knowing what one doesn't like. So we need to understand what a continuation looks like. And we need to know that because that's something you don't want to step in front of, because that's a mistake a lot of traders make. Now, every trade in the market is a buy and a sell. So when we build these small ranges, we're building positions on both sides of the market. Okay? But we have to always consider that the probability is on the side of a continuation. Now, what we can also see, we've actually got the volume number here, 51k, 40k, 46k, 29k. We can also see that as the market moves down, we can see that the pushes down always have greater volume than the pullbacks up. Okay, sounds obvious, but it's one of those things you always have to keep an eye on, because when the volume switches, again, it's another sign that the market's reversed. So the major reversal is going to occur when one of these volume ranges fails and we go back in the opposite direction. Okay, in this case, it's going to be when the sell side traders start to feel the pain instead of the buy side traders. Okay, and it is absolutely inevitable that this will occur at some point. And the reason it's inevitable is because all sellers need to buy in order to take profits. So at some point as we move down, there simply won't be enough people willing to enter the market short, and profit taking will eventually overwhelm the new shorts. And if you want to know why people will run out of people who are willing to go short, we've all got a limit on the size of our accounts. We've all got a limit on the size of the positions we can take. So even if you think this market's going down and you add to your position, you're going to run out of funds at some point. You're going to hit your limit at some point. Okay, so everybody's got their, a certain amount that they're willing to risk. Okay, but basically, when the shorts start to feel pain, you get to a point where the shorts profit taking is eventually going to overwhelm new shorts or entering the market, and when people see that happen, they're going to switch bias from short to long. Now, in this picture here, I've actually reset these meters, the current trades, and also these current trades here at the low, but not because I know it's going to reverse, but just because after a push down, I want to keep an eye on the delta. I want to know what is happening right here and right now. Okay, so I don't care that there was negative delta 20 minutes ago. I want to know what's happening right now. Okay, so we can see that large sellers sold fairly aggressively down to 74, but we can actually see now we've actually got some buy side aggression here. Okay, now I just want to say also that these screenshots are from a video recording. Okay, so the resetting of the meters wasn't done kind of just to impress you. It's just something I do all the time. So it's not like I reset this meter, man, this guy's smart, he reset the meter when he knew it was reversal. That's not what I'm doing here. I can reset the meters after a push down. Okay, so the meters are positive right now, but in a range, as we build the range, as we move up, obviously the buy market side will kind of be in greater quantity to the sell market side. So we're going to have kind of positive delta as we push up and negative delta as we push down in the range. So you don't want to jump on just those delta shifts. Now, if we look at some of the other stuff we can see the Dow here is obviously still looking very bearish, and also the NYSE tick. Okay, and we built a range again, and we can see what we've been seeing before. We're starting to build the range. Dow's flattened out. The NYSE tick is bearish. The strength meters have actually flipped at this point and are actually showing more strength on the buy side. And the delta for the first time, if we look at the delta here, it's actually up 6,000 contracts from the low. Okay, and that is absolutely a heads up. Okay, but this is not a confirmed reversal. So at what point, if we're looking at this market, would this be a confirmed reversal? And it would basically be a failure of this mini range from 74.50 to 77. And that's where many real people, just like you, just like me, in short positions, if we go through the top, that's where they're going to feel pain for the first time today. Now, the other thing, we talk about short traders and long traders. We all know there's no such thing as short traders and long traders, okay? Most intraday traders are playing both sides, but some shorts will be stopped out if we push up, and they're going to cause a further push up. Their stops are going to see us accelerate. The other guys that don't get stopped out, that are still short, are going to see that. And they're going to do exactly what you and I would do when they see that range fail and they see that acceleration up. They're going to start to take profits by buying. Okay? So continuation traders at this point could look to sell 76.75 and maybe scale some at 74.50. And reversal traders could buy as low as they can in this range, possibly scale some off at 76.75. Now the scaling is optional, but it's there to give you a buffer if you end up on the wrong side of the range breaking. So for me right now, I wouldn't play this as a reversal. So for me, I don't play the major reversals. I wait to let them happen, and then I play the continuation. But there's many ways you can play this, and you know, we're not talking about entries and exits today. It's about how and why reversals occur and how to distinguish between reversals and pullbacks. So the first heads up really that reversals potentially coming in is this imbalance in the delta, cumulative delta here, on the time and sales, on the strength meters if you use this, but basically it's in the order flow, seeing the order flow put in a significant switch, which it hasn't done on the way down. So as we move down, you can see there was no time at which the delta actually made a positive move as we pulled back, but here in this area we can see it's now moving up. So we keep an eye on the delta. Okay, so now we can see that one of these ranges has broken to the upside. So we've got a mini range failure to the upside, and now we're actually threatening to kind of move into this little range above, this one that's kind of like where we've got the high volume 1980 to 8075. We've actually put in a small downswing on the chart, and in that downswing there was no delta, so kind of absent of sellers in that downswing. And the tick is also looking to move up, and so is the Dow. So if the sellers in this range below are now washed out, we're going to expect a lack of sellers when we get back down to this 1977 area. Okay, because everybody can see the price is swinging up, right? Okay, but we have the added information that the price has swung up and actually stopped out a bunch of people. Okay, if there wasn't a huge amount of volume down here, we'd kind of be looking a bit higher for where people are getting stopped out. Okay, so we know how those guys feel because that's happened to us. We know how the shorts in the market are going to feel because we've been those guys too. But we also know that people now are going to be looking at the price action and coming in long. Okay, so just watch the pink line here and watch the volume here as we switch. Okay, so looking at the pink line, we come down to trade a handful of contracts at 77.25. And I just want to say something. The reason I'm using the 3rd of February, a day from this week, is to try and convince you that I haven't cherry-picked these charts. I haven't cherry-picked this information. You know, we're doing this on Friday. I just picked, just did a recording on Tuesday and prepped the slides. Okay, but it's not always going to be to the tick. Oh yeah, okay. So we said we're going to look at 77, the area where we've got a step in the profile. It's come down. Don't expect it to always be to the tick. But the reason the market held at this price, it's because of you and me reacting the way that you do when you win and lose. Okay. Now we know that not all positions are short term, but we do know that short term traders are most likely to set the tone in the short term because they're the guys reacting in the short term. All intraday traders do that. So we know that the shorts below 77 got stopped out. And the simple fact is, those guys are not going to be in a hurry shorting that area in the immediate future. Now also, if we look at the delta, the Dow, the price action, the cumulative delta, the meters here, they're all starting to kind of show that the market's turning positive, okay? And everybody can see that. Whatever people are looking at right now, it doesn't matter what you're looking at, it's starting to look bullish. There's lots of people seeing that. There's plenty of upside, and we know how that's going to make the shorts feel because we've been those shorts, okay? Now to the downside, if we get long, we really don't want to see it start eating back into this volume area here, okay? So that means we're going to start to head back down, or worse, enter a really ugly sideways range. Okay, now what we can see, as I said, it doesn't always work to the tick. We can actually see we've come down and we've traded to traded through 1977 to 96.50, just a few ticks break, but we haven't managed to kind of stay within the range. The nicey tick is up and down. It's not really giving us much indication. Delta's come off slightly, but that's not bearish. Certainly that's not really a significant move in delta. The delta to the large trade size down here is bullish. This is going to make you nervous, okay? So if you're long here, it's going to make you nervous because there's a lower low. But from a volume perspective, there's really no sign for alarm. There's no evidence that we can stay in this lower range or that sellers are in any way overwhelming the buyers. So the chart's ugly, okay? And one of the things that's common when a reversal is nice and obvious like this one, because let's face it, this swing up here is pretty obvious and we had the other markets cooperating, is when you get something like that, plenty of traders get long, and there is a tendency for the market to get pushed down to shake people out. And when we got that lower low, absolutely that will have shaken out some of the longs. So the price action here is telling a slightly different story than the one we get when we consider where people's positions and stops are. Okay, so with that done, we get a pop out the top of the range and we see one-sided trading to the buy side. What we also see, we see a big shift in the delta. As I say, large trades on the buy side. Look at the time and sales here. Look at the blue bar here. We can see the trades on the buy side. We can see the Dow's up. We can see the nicey tickies up. And again, this continues: range, move, range, move, range, move. Okay, and here is where we have a potential failure. Okay, so this is a bigger pullback. Okay, and we can see actually there's some delta move in this pullback too. But the Dow is still up. It would be nice to see what the Nasdaq was doing, but the chart's frozen. The tick, we see the tick's weak. The tick's quite strong on the way up. We can also see that when we were moving down in this move down here, the tick was pretty weak on the way down, and at no point did we breach a volume cluster below us. We haven't taken out longs. So the longs haven't got stopped out below. And what we're doing here is getting a lot of reversal traders trapped. Okay. So look at what we've got here. We're at the high of the day. The market's rolled over. Everybody's thinking that's a double top. Okay. So lots of traders have faded this move, but we're just looking at this range here. We're looking at this volume range here. And we're not getting back into this volume range below. Okay, now this is a pretty obvious trade. Okay, and with obvious trades like this, like a double top, large traders know very well that Mr. Retail Trader is going to short up here, and all they have to do is take their foot off the gas. All the large traders have to do is kind of stop buying for a while, let the market come down, and then drive it up to stop them out. Okay, so my preference again is never ever join obvious trades like this. And if I've gone short, to perhaps even get out of the market when I see it obvious like this. Now, unless we get a cluster of positions to get taken out, I'm just feeling I'm still bullish in this market. Okay, so with how obvious this is, it's no surprise that this is where we got to next. Okay, so we had a big push up. It was initiated by a move through the top, but the fuel for the move up was those reversal traders getting stopped out. Okay, that's what's happened. This isn't a bunch of new buyers coming into the market necessarily, although probably we did get new buyers helping to push it up through there. This is guys getting stopped out. Again, we can see the one-sided trading on the way up. So basically, the guys that took the shorts here are seeing a price move, joining in, but they're not considering at all where other people's positions are, how obvious their own positions are, and the fact that basically continuations are always the highest probability. Now, what I'd like to say is this today has been told kind of a bit more like a story of a day than a set of rules. And the reason I've done that is because each day is actually playing out like a story. It's speculative trading driving the market. Okay, traders are getting trapped, they're stopping out, and then those stop out areas become places that they don't want to feel that same pain again. So we look for those high volume pain points, and we look to see if traders get stopped out as we leave with that one-sided action as we move away. Now, if you move away from a volume area and you don't see one-sided action, you just see kind of a weak move out, the chances are it'll move back into the range because nobody's got stopped out yet. Okay? Now, we're not considering actual prices traded as much as we're considering the positions at each price and the overall balance of trade. So if you're trading just off price points right now and it's not going so well, or you don't feel you've got a good kind of reason to get in and out of trades, taking this kind of perspective on trading should help. So no longer looking at just kind of the lines or the moving averages or the wicks of your candles, but actually considering everything in terms of speculation, paying, and what positions are held. And with that, Eddie, I think we're done.
Peter, appreciate that. And I'd like to thank you for the time, the presentation, and all our friends and fellow traders here that stopped by for the presentation. Good stuff, my friend. Now, if you do have any questions, by all means, jump in the Squawk Radio Room. Guests, by all means, you too, participate. If you do have any questions for Peter, we are open for them. I'm going to start here with, we got one of our guests, Willie Mack. Question for you, Peter. On your zigzag, what setting, i.e. 3-bar, 7-tick, or
900 tick, says at the top. I use a 900 tick chart because basically I trade the mornings, and as you can see, the 900 tick chart generally right now is good for seeing the Globex action and the morning's action. There's no real reason for it. It's just sometimes if the market gets a little thicker, I'll change that. But obviously it's just 900 tick bars, and as you can see, I try and make the price bars themselves fairly invisible. I don't really want to kind of pay too much attention to individual price bars, but it's 900 ticks basically, and the reason is it lets me see the swings and it lets me see the morning's action and the Globex action, but there's no other reason for that. I can see merits in lots of different types of charts, and the thing is, you can look at yesterday and like play around with time frames for yesterday and find a perfect chart, a perfect time frame for yesterday, but it sucks today. And I just think you just have to stick with one or look at 500 charts. So 900 ticks just kind of what I end up sticking with.
All right, thanks, Peter. Now, Fred has a question here, sort of off the side here a bit. He says, you seem to understand spread trading. Do spread traders have an edge over directional traders in your opinion?
They have an edge in terms of quite often being able to get out of trades that are kind of not so good without losing too much money. So, kind of getting a few ticks back. Some of the things against spread trading, I mean, I might be unpopular for saying this with certain people, but one of the reasons that a lot of prop shops prefer their traders to trade spreads is lower risk, but it's also higher commission. So, you've got it, with spread trades, you've got two sides. I mean, there are exchange traded spreads, but you get two sides. It's not something I ever was interested in because people are saying it's lower risk, da 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 da. But all trading it's all about getting into a position because you think something's going to happen afterwards. And I don't think you can really avoid that. I don't think no matter what kind of trading you're doing, you've got to get a position because you think something's going to happen. And I don't really see why spread trading is any different in that respect or any other kind of trading. So yeah, they might have an edge, but I think a lot of spread trading in prop shops is somehow kind of driven by commissions than it's a better way to trade. Like I said, it might be unpopular.
All right. Peter, Fred says he looks at daily volume and uses market profile as an analytical tool. He says, I was wondering about the intraday volume. Mm-hmm. I've looked at volume studies on my 30-minute chart, which wasn't much use. I have heard of people writing down volume every 15 minutes or 30 minutes. I wonder if you have any suggestions.
Yeah, I had the same thing because, it's difficult if you like. I've got a 900 tick chart there, so if I had the individual volume for each bar down there, one bar might be 30,000, the other one might be 28. Really, really hard to read or distinguish anything. The only time you're going to see something is a massive outlier. So if you look at the swing charts here, the 27k, 31k, 14k, that's the amount of contracts traded in the swing. So for me personally, I've found that the number of contracts in a swing really, really helps. Because basically as the market moves up, generally speaking, you get a lot more volume in the upswings. And when you start to get more volume in the downswings, it's just a hint that, there's basically more participation in the moves down or the moves up. And I've found that of use. I found that of immense use. But I've really struggled with the volume for individual price bars. And then the other thing I do, I have an indicator that's not really very well written, but it kind of shows me the average volume, or rather how far from average volume we are from the time of day. So it'll show me if, like today, we're like 100, at 10 o'clock, we're 100,000 contracts above average. And I kind of use that just to get an idea if the market's going to go into a range or not. So when the average starts to decline, or the comparison to average starts to decline, and there's less interest in the market, I think that's useful. It doesn't give you direction, but it kind of tells you when the market might be about to just start to turn sideways.
All right. Thank you, Fred, for the question. Thank you, Peter, for the answer. One of our guests, Brian W., has a question. Can you have candles, positive buyer numbers and negative seller numbers inside the candle?
Positive buyer numbers. Well, that would be like the delta basically, because obviously every trade is a buy and a sell. But you could have positive buy market and negative sell market in the candle. I think I've seen software that's doing it, but I think especially with 900 tick charts, I think paying attention to individual candles as opposed to where did the market swing around can really, I think it's over analysis for me anyway. So like I like to just say, okay, where has the market turned around, and kind of pay more attention to that than individual candles. So that's why I kind of just use the delta below and kind of look at the meters.
All right. Thank you, Brian. And moving on to Tony L. Tony says, does it matter whether one uses a non-Fibonacci number on their tick charts, such as 900 versus 987?
For me, the tick size I use, okay, and it probably covers the next question as well about tick size for crude. You want to see where the swings were. So as long as the chart time frame lets you see where the market moved around, or whether, that's because where the swing sizes were, where the swings were, that's where people were in pain. So I don't think it matters what time frame you use. I really don't think it matters. If I started using 800 tick or 1000 tick on Monday, it wouldn't make any difference at all to the trading. So I think you just want to see where the swings were. And I would say for the more volatile markets like crude, seeing where the swings are is more important than if you're like trading US Treasuries. And if you're trading US Treasuries, there's so kind of few major, so few swings intraday, you're actually better off just using the volume profile itself.
All right, and thank you, Tony. And Atomic's got a question. Have you ever tried trading crude? If so, what parameters, tick, chart size, etc., would you use?
Yeah, I think we just did that basically. It's just you use a lower tick size, like maybe 150 ticks, something like that, because you want to see more of those intraday swings. And obviously, it's a much lower volume market anyway.
All right, thanks, Atomic. And Rob Tix has a question, another guest. When controlling risk and position sizing, one must consider volatility. Do you trade any other instruments if the ES gets too fast?
Yeah, in theory, but I haven't this year. I mean, at the end of the last year, I traded a bit of the treasuries, but yeah, I should really for this year. I should have changed the treasuries, but the answer is yeah, I should, but I've kind of just couldn't manage to drag my way away from the ES. Sometimes I find it, I went through a period, for instance, where the market's really slowed down, and I really what I should have done then is actually move to a faster market, but I kind of found it a bit of a challenge to kind of like finally, master like a slower market. And so for this year, yeah, I should have gone to treasuries, but I've been trying to really get to grips with the volatility on the ES. So yeah, I should, but I didn't. Basically, not this year. Yeah, it's hard to walk away. It's hard to walk away because the other thing is, it's like you are really trading the volatility. I mean, you're trading a market, but you're actually trading the kind of behavior and volatility in the market. So yeah, right now the treasuries might be behaving more like the ES, than the ES is. But like Scott says, you watch something every day, it's kind of hard to walk away from it.
All right. All right. Well, Peter, it seems that's all the questions we have right now. Now, for those that are guests here today, if you'd like to join us, the broadcast here is free, and we do have the privilege to have Peter on with us every Tuesday and Thursday at 9:35 Central, and he does have his visual presentation. And, of course, just about every day here in our equities room, Peter definitely puts out there the pre-market prep for the ES, so get a look at that before you start trading. But otherwise, Peter, anything else you want to add? I put the post up for your Twitter. I've got jigsawtrading.com if you want more information on Peter. He also has it up here on the presentation, so bookmark that.
Nothing else to add. Just thanks everybody for listening, and thanks to TopStep for giving me a chance to come and talk here today. And have a good weekend.
I will. You do too, and I'm sure the community here. Good weekend for rest. We've got a big week coming up next week. But otherwise, Peter, once again, thank you for your insight, your friendship, and the education that you shared with us.
No problem. And I'll see you next week, Eddie.
All right. Take care. Thanks a lot.
Bye.
Bye-bye. All right. If you're interested, there's the website, jigsawtrading.com.